And welcome back. Those are the big headlines that we'll be tracking for you on ET Now today. Now let's tell you about the first topic at hand, and that's financial planning for the youth, for Gen Z as we could call them. This essentially is step one of financial planning, a process that continues all the way into retirement and after retirement as well. Inculcating the right money habits at a young age definitely does go a long way. So that's what we will be doing today, acknowledging the fact that it's also National Youth Day today in India. So to take forward this conversation, I have with me Mrin Agarwal. She's the founder director of FinSafe. Mrin, always a pleasure having you with us today, with us on the Money Show, and season's greetings to you and your entire family.
Thank you, Mabina. I wish you the same.
All right, thank you, Mrin. So, like I mentioned, we want to sort of throw the spotlight and, keep this show around Gen Z, their spending habits, their investment habits. Now, like I, said at the beginning of the show, most of the youth will argue that, listen, I don't earn any money. The only money that I have is the pocket money, perhaps, that my parents give me, and maybe the monetary gifts that's bestowed on me by some very generous relatives. And I'm sure these are the favorite relatives of these youngsters. But, and yes, there are very few that do have, a part-time job perhaps, or a side hustle. Not surprising if many of them have even started off small businesses as well for themselves during this lockdown. But the point is, it's going to be not too much money. Is it enough to kickstart financial planning, or to, get the basics of financial planning lessons right, Mrin?
I really think it is, because a penny saved is a penny earned. And while you may not be earning money right now, but I think it's really important to do something useful with that money. I know at that age, doing something useful means acquiring a gadget or spending it on an experience maybe. But I think, if a small portion can actually be allocated towards saving and investing, I think what happens with that is that you kind of start building this habit early on, and it just gets into your system that, that you have to put this money away and that you have to kind of invest this money on a regular basis to kind of look at building a passive income. So I think the way it should be approached is to say that, hey, I've got only this much money from pocket money and gifts. How can I actually grow this money so that I have more money available at my disposal?
Okay, so what would be step one then in terms of financial planning for these youngsters? Where would you start them off?
I would say step one would certainly be finding that number that you can save. So if, whatever money you get, what is that amount that you can save? Is it like 10% of the amount? Is it 20% of the amount? Is it 30% of the amount? I think the first step is really going to be about finding that number and staying committed to it. So, don't look like a big number, like saying, okay, I'm going to save 30%, because it's not going to happen. So, start small, take some baby steps, but find that number that you're going to save every month and, do something useful with it, basically.
Okay, I think the one thing though that we could correct, or we see potential to correct in youngsters, is the way they spend their money. And Mrin, actually, I know for a fact that there are now a lot of fintech companies that have come out with products targeted towards the youth. There are preloaded cards, there are otherwise post-paid cards as well that are the youth can use. What's your opinion on those? And keeping it with that, in general, spending habits that you think the youth could kick?
So I think, this is a very important age to also build the right spending habits. And I know that there's a lot out there that people want to have. But I think what is really important is that if there is that big purchase that you want, or there's that, big spend that you have, I think you need to try to figure out that how much of it can you save up for it, rather than, just jumping in for a loan, because it's very easy to get loans. I mean, we've all been reading about these Insta loans, which are very easily available just by the click of a button. But then a lot of these loans come at very high rates. And I was actually reading that most of these loans, some of them can even come at like 100% interest rate sort of a thing. So I think what is very important is to really stay away from all of these loans. And yes, as you rightly said, there are a lot of loans which are targeting youngsters, let's say to buy a laptop, to buy a smartphone maybe, right? But I think what is important is to basically save for it on a regular basis. Maybe you do a deal with your parents to say that, look, you want this big thing. And, if the parents can fund a larger portion of it, and the individual shows some commitment to save some amount for it every month, I'm sure that the parents will be more open then to, spending on it. And that's a much better way to buy things than to actually take a loan. So I will certainly say stay clear of all of these Insta and these easy to get loans, because what also happens with these loans is that you get into this habit of taking loans for small things. So I've been hearing of people taking loans for 2,000 rupees also, right? And it just becomes like a monthly activity then, and it just spirals and it gets very difficult to get out of it. So I think that's one thing that you really need to steer clear of.
Yes, and I think once you get into that habit of buying now and paying later, unfortunately, it tends to stick with you. You will do that even perhaps for the the bigger decisions in life, and that's when you really get into this debt trap. And like Mrin said, you have a lot of these financial products that target the millennials and younger people. And yes, from their business perspective, it's great. But I think for millennials and for the younger ones, you should ensure that you don't get into a debt trap of sorts. Don't take loans and buy things because if you have to take a loan, try and take it for absolute necessities. For example, let's say buying a home, you'll be taking a loan, but that will be for an asset, an appreciating asset. It's better not to use it for especially discretionary spends like eating out, going to a restaurant, so on and so forth, or even buying fancy laptops and fancy mobile phones. So I think this is a word of advice coming in from Mrin. It's a very important one as well. So Mrin, let's say that you do have some very responsible young ones out there who try to save at least maybe 500 rupees per month or 1,000 rupees per month from everything that they get on a monthly or a weekly basis. How do you recommend they start off the investment journey? These are the ones that don't really have to pay for expenses at this juncture. They live with their parents more often than not. So the parents, or even if they live away from their parents, the parents usually take care of the finances of this individual. So it's a great time really, because the money that you do earn or do get as gifts are yours completely. So it's important to spend it responsibly or use it responsibly. So Mrin, how would you start them off on maybe investment options?
So the first thing is that don't jump into things. So we do a lot of college literacy sessions, and what we hear is that a lot of students are actually investing, but they're investing in all exciting things. So I've heard of students doing options, and of course Bitcoin is the in thing. I know it had a big fall today as well, but options, Bitcoins, and stock trading. We get so many questions on stock trading, it's not funny. So what I would like to say is that firstly, it is the simple, boring stuff that actually makes money. And unfortunately, all of these exciting things don't really make money in the long term. Very importantly, before you invest into something, read, because, I think this is one thing that is lacking with most investors, irrespective of their age group, is that they don't bother to read and assess an instrument before investing. Some 2-3 very basic things, when you are looking at an investment product. First and foremost, is it regulated, right? Bitcoins are not regulated in India. So is the product regulated? What is the risk in the product? So if I'm putting 100 rupees, can I just lose the entire 100 rupees? If so, am I ready for that or not, right? So very important to look at risk. Unfortunately, everybody looks only at returns. The third thing that I would say is that don't go by the investment biases of the elders, because typically what happens is that when people start earning, then the elders would always say that, okay, go and buy an insurance policy. I think it's the age where you can take some risk. So I certainly think that one of the instruments that you should have should be exposure to Indian equities. I mean, world over, people are taking exposure to Indian equities. Why should you not have it?
Okay, all right, fair enough. Well, I hope everybody out there is, taking in lessons from everything that Mrin has to say. If your parents, of course, to teenagers, please do impart these lessons to them as well. And let's hope that they get into this habit of proper financial planning from a very young age. It will definitely reap benefits for the future as well. Okay, let's take on board some questions and queries as we usually do on The Money Show. Remember, folks, if you have any queries, you can write into us. Our email address is themoneyshow@etnow.tv. And we'll get your questions answered right here on the show. So let's take on board our very first question. We have Mr. RBS Reddy saying that I'm 63 years old, retired, and risk profile is obviously moderate. He will not be able to take on much risk because now he does not have that regular stream of income coming in. He has a surplus of 45 lakh rupees, which he will not need for another 10 years, but he's invested them in 3 debt mutual funds in December 2020. So it's 15 lakh rupees each in the Mrin Asset Short-Term Debt Fund, Axis Banking and PSU Fund, and Kotak Low Duration Fund. He's also started an STP of 15,000 per month from each of these mutual funds. So it's investing money from these debt funds to equity funds for 5 years from January onwards. So the equity mutual funds are Mirae's ESG Fund, Axis Growth Opportunities, and Kotak Pioneer. So the same AMC's equity funds. Now he wants to know how should he grow his surplus amount with an annualized inflation 3% return in 10 years, and if he plans to review his investments as well in the middle of December every year, which is great. And also he would like to ask you, Mrin, is his investment strategy and mutual fund selection right in your opinion? Mrin, what would you recommend to him? Because I think he's more or less started off with investing in mutual funds only in December 2020, 3 years or a couple of years at least into his retirement.
So first and foremost, I think his investment strategy is not correct, because he has chosen a short-term fund, he has chosen a banking and a PSU debt fund, and then a low-duration fund. And while it's okay to use the low-duration fund for an STP, I don't think that you should use a short-duration fund immediately after investing for an STP. Firstly, it's not going to be tax efficient either in any case. But remember that the short-term funds and banking and PSU debt funds are meant to be longer-term investments for 3 years plus. Now, the issue is this, that at this point in time, when we are at pretty much the bottom of the interest rate cycle, there is an interest rate risk that is involved with the longer duration funds. So which means that if interest rates were to go up, the NAVs could drop. So hence that volatility factor is there. So what I would say is that, at least he should remain invested in the short duration and the PSU debt fund for 3 years. And after that, if you want to do an STP, it's fine. But I really think that this strategy of, doing an STP right away from a debt fund is not right. Now, as far as the equity funds are concerned, again, he's mentioned that he's got a moderate risk profile, but then he's into thematic funds. I know one of the funds is an ESG fund, so it should be kind of okay. But, he's got like this thematic, I think he's got a Pioneer fund, which invests in some technology, new technologies and stuff like that. So I think the fund selection is really not of for a person with a moderate nature. In fact, what I would recommend, a better thing that he could have essentially done was to, maybe keep these money in the debt funds, and, that part in the Kotak low duration, maybe he can look at moving that out into a flexi cap fund, maybe. That could be an option that he could look at.
Okay, so just a few chops and changes that Mrin is recommending. The strategy as well that Mrin does have in mind. Banking, PSU, and these short-term funds are usually meant for longer holding periods. You have to choose a debt fund only based on investment horizon, and yeah, keeping it with that banking and PSU bit. Always be very cautious when investing in thematic funds. We've spoken to Mrin about her view on thematic funds in the past as well, and she hasn't really, she does not really recommend it for investors because it involves a lot of reading of the economy, the markets, and for those individuals who have their 9-to-5 jobs or who may not be that financially savvy, sometimes it's difficult to sort of peruse what the market news is and apply it into how the market could move. So it's best avoiding thematic funds. Okay, let's take on board one more query. We have Ejaz saying that I invest in the following funds, quite a few. I think there are 8 funds. There's once again an Axis Banking and PSU fund, so a thematic fund over there. Axis Blue Chip Fund, Parag Parikh Long Term Fund, which has done well. Another multi-cap fund, Kotak Standard Multi-Cap Fund, Mirae Asset Emerging, L&T Mid Cap, HDFC Small Cap, and the DSP Tax Saver Fund. Now he says that this Kotak Standard Multi-Cap will be changed to a flexi cap fund, and there's no exit load till the 31st of Jan. He also adds that since I hold Mirae Asset, Blue Emerging, Axis Blue Chip, and Parag Parikh, is it fine if I exit Kotak and reinvest in the existing funds, or perhaps in an international fund? And in that line, Mrin, he asks you, what about a PGIM India Global Equity Opportunities or a Motilal Oswal Nasdaq fund of fund? So Mrin, what would be your opinion, or do you think he should stay put with Kotak Flexi Fund?
So honestly, it's a good fund. There's nothing wrong in the fund. But if you want to do a consolidation, if you feel that you want to bring down the number of funds, because he has got 8 funds, and if you really want to bring down the number of funds, then you can exit because you're able to exit without an exit load. Of course, we don't know when he is invested and all of those things. But what I'm saying is that you can do it provided you want to do consolidation in the portfolio, but then the amount from it, please go and reinvest it back in a flexi cap fund. I know that there is this big fancy for international funds, over the last 6 months, and everybody wants to invest in them. But you need to really ask yourself, where does this really fit in your portfolio? I mean, it has given great returns, no doubt, but where does it fit? Secondly, the international funds have a debt taxation. So are you aware of that? And I think that the easier way to actually do this is, just stick with some of the funds, which in any case is international exposure. For example, you have the Parag Parikh Fund. Now, if you really do want to do an international fund, I would say do a diversified fund. If you look at the Motilal Oswal, it's a Nasdaq ETF, right? So obviously it's going to only take exposure to tech stocks. And while tech stocks have done great in the last 1 year or the last couple of years, you can't really say how much more they are going to perform or how they're going to do, So all I'm saying is that if you are taking exposure to international funds, look at diversified always over taking a concentrated risk in one type of or in one sector only.
All right. Well, there you have it. That's, I think, the time that we have to take some questions and queries with Mrin. Don't fret, folks, if we've not been able to take your question. We will be doing so over the course of the next few days on The Money Show, so stay tuned. And, of course, keep writing into us on The Money Show at etnow.tv. Mrin, on that note, thank you so much for joining us today on The Money Show and helping our viewers out as well. Lovely having you with us. And what we'll do is now take a very short break on the show, but when we return, we'll be joined by Rohit Singhania of DSP Mutual Fund. He manages, among many funds, the DSP Tax Saver Fund. So we'll be bringing him board in our Meet Your Fund Manager segment. Don't go anywhere.